Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. As mentioned on Friday's morning briefing, we had a change in the larger time frame after taking the July's low and re-entry the previous 4-month range that we had earlier in the year. Now on Friday we had further extension to the downside, although it closed off the lows with a little bit of a responsive. I'll get to that in a second. So now we have a possibility of a daily excess, depending if that late sentiment continues to push back up. That needs to be confirmed. But to the downside, the next reference would be the gap left in on June 18, and we need to keep an eye on the 29.15 area because now we have, as you can see here, three multiple lows, three in that area. So that area is not very safe, not very secure. Uh, if we have a look to the market profile, we can see how we had a relatively strong directional conviction from the open, and the move repaired the weak structure left um, in at the end of June, all the way down until finding support at the previous FOMC low in the 29.1350, 29.15 area. Now, value was essentially established lower with volume supporting the move. And let me zoom in a little bit. So values established lower, and we had volume supporting the move. And while the market seems to have gotten a little bit short through the session, and we can see that after a pullback and we retry the lows, we couldn't get there. Got close, but it couldn't get there and started making higher highs. That suggests that, I mean, it could have gotten a little bit too short. However, so we had that. I mean, sorry about that. We got a little bit short, and the reason I said that is because two things: inability to reach the low, and we had a kind of a spike move that seems to be short covering. Now, despite that, as I said just a few seconds back, value was established lower and volume was supporting the move. So the little excess that we have down here, this is just like 4 ticks, 3 ticks, plus the inability to re-enter Thursday's range tells me that I don't think the downside move is done. It's not over. We just had an inventory imbalance, and the market needs to correct that before going further. So immediate focus is on value development relative to the afternoon low at 29.27. That's the M low. I have marked here with the yellow arrow. If we have a failure to get acceptance below that level, that will suggest the hypothesis that the market at least will be in temporary balance, and we will have actually a little bit of daily excess. However, if we do start getting below that level and finding acceptance, that will increase dramatically the odds that we will revisit this questionable low. And we need to pay attention, as I said, because it's a multiple day low, and then we will have to pay attention to what happens at that gap. As I always say, anything can happen because odds are just odds. Remember the context of why this move started. We have first a little bit of disappointment from the actions that the FOMC took. That was a little bit reversed or fixed the next day, but then we had very negative developments on the trade front. So the market's focus at the moment will be, yes, there might be a little bit focus on the economic data to try to anticipate what the Fed will do next, but I think the primary focus will be on further developments on the trade front, and if things start, doesn't get well relatively soon, we can have further downside.